I have stood on the floor of exchanges when the noise was deafening. I have watched fortunes built in silence and empires collapse in a single afternoon. And in all my years of reading the tape, studying the pulse of the market, one truth rose above every other. The market speaks to those who know how to listen. And it speaks in two languages, price and volume. Most men hear only one. They chase the price. They watch it climb and feel the pull of greed, or they watch it fall and surrender to panic. But price alone is an incomplete sentence. It tells you what happened, but not why. It tells you where the market went, but not whether it had the conviction to stay there. Volume, that is the other half of the sentence. That is the voice behind the words. Now, before we go further, I want you to do something. Go down to the description of this video right now and look at the two books we have prepared for you. The first is called Thinking Like Jesse Livermore, Mastering the Market with Discipline, Patience, and Risk. The second is the Livermore Journal, a 90-day trading psychology workbook. These are not casual reads. They are blueprints. They contain the very principles I am about to discuss, but compressed into a system you can apply to your own trading day after day. The links are in the description. You will want them before this video is over. Now, let us begin. The relationship between price and volume is the most fundamental concept in technical analysis, and yet it is the most ignored. I have seen men study charts for years, memorizing every pattern, every line, every formation, and still lose money because they never once asked whether the volume behind the move confirmed what the price was telling them. Here is the first principle, and I want you to burn it into your mind. When price moves on high volume, the move is real. When price moves on low volume, treat it with suspicion. This is not a suggestion. This is a law. A stock that rises 10% on thin volume is not a breakout. It is a whisper. It may look convincing on the chart, but it has no body behind it, no commitment, no institutional sponsorship. The professionals, the ones who move markets, they do not buy in silence. They cannot. The sheer size of their positions forces volume onto the tape. When the big money moves, the volume tells you. I remember watching a stock in the 1920s that moved beautifully through a key resistance level. The chart was clean. The breakout looked perfect to the untrained eye, but the volume was half of what I would expect on a move like that. I stood aside. Within 3 days, the stock had reversed completely. The so-called breakout was a trap, a low-conviction push that lured in amateurs before the professionals took their money. This is why I always say, and I have said it in my writings, that the action of a stock in relation to its volume tells you everything about the intentions of those who truly control it. You cannot fake volume. A stock can be manipulated in price. Pools have done it, operators have done it, and they will do it again. But you cannot indefinitely fake the participation behind a move. Volume is the honest testimony of the market. Now, there are 4 basic combinations you need to understand, and I want you to see them clearly before we move deeper. The first, price rising on rising volume. This is the purest bullish signal. Demand is increasing. The market is confirming the move. Buyers are committed, and the move has legs. This is what you want to see in a genuine uptrend. The second, price rising on falling volume. This is a warning. The move is losing its engine. Fewer and fewer participants are supporting the advance. The rally may continue for a time on momentum alone, but it is running out of fuel. Begin watching for reversal signals. The third, price falling on rising volume. This is distribution. The professionals are selling heavily and urgently. The market is confirming the decline with conviction. This is the signature of a trend change, not a temporary pullback. The fourth, price falling on falling volume. This is a correction within a bull trend, not a reversal. The selling is half-hearted. The decline lacks commitment. In a strong uptrend, this is often the setup for the next leg higher. If you have ever wondered why some trades work perfectly and others fail despite a clean setup, the answer is often here, in these 4 combinations. Price tells you direction. Volume tells you whether to believe it. If you want to go deeper on understanding how to find the right trade at the right time, I urge you to watch our video titled How to Spot the Right Trade at the Right Time. That video walks through the complete trade selection process, and when you combine it with what I am teaching you today, you will see the market in a way most traders never do. Watch it. The link is in the description. Now, volume has another dimension that most traders completely overlook, and that is its relationship to time. Not just what the volume is doing today, but what it has been doing over days, weeks, and months. The accumulation and distribution of large positions does not happen overnight. It is a process, and if you know what to look for, you can read the footprints of that process in the volume record before the price move is ever visible to the casual observer. You see, the market does not reward impatience. It rewards preparation. And there is no better preparation than understanding what the large operators, the banks, the funds, the institutions, are doing with their positions long before the public ever hears about it. They are building. They are accumulating. They are quietly absorbing shares over weeks and months, keeping the price suppressed, preventing a breakout until they are fully loaded. And then, and only then, do they allow the price to move. How do you see this? You see it in volume patterns. During accumulation, you will often observe periods of sideways price action with persistent, slightly elevated volume that seems inconsistent with the lack of price movement. That inconsistency is the clue. Something is happening beneath the surface. The price is being held in a range while large positions are assembled. I have spent countless hours in my career reading the tape for exactly this signature. A stock sitting in a 2-month base, price going nowhere. And yet, day after day, the volume runs slightly above average. Not dramatically, not in a way that draws attention, but persistently elevated. That is accumulation. That is the invisible hand of the professionals at work. The reverse is equally true. During distribution, when institutions are quietly unloading their positions into public buying, you will see the same phenomenon in reverse. Price may still be rising, or at least not falling sharply, but volume begins to act strangely. You will see big volume days with little upward price progress. You will see the stock unable to hold gains. You will see what the tape readers of my era called churning, massive turnover with minimal net movement. That is the market absorbing the selling of those who know the game is nearly over. This is precisely why I always insisted that no trade be taken without consulting the volume record. A stock can look beautiful on the chart. The pattern can be textbook perfect. But if the volume during the base was thin and unconvincing, if there was no evidence of accumulation, no sign of large money quietly positioning, then the breakout that follows is built on sand. It will fail. The smart money was never there. The move belongs to the hopeful, not the informed. Now I want to discuss something called the climax run, one of the most powerful volume signals in the entire canon of technical analysis, and one of the most misread. A climax run occurs near the top of a long, extended uptrend. The stock has been rising for months, perhaps years. The public is fully invested and fully enthusiastic. The news is glowing. And then, one day, the stock surges on enormous, truly enormous, volume, far beyond anything seen in the prior trend. A massive, emotional, breathtaking move to the upside. And the amateur looks at this and sees triumph. He sees confirmation. He buys. The professional looks at this and sees a funeral. That climax volume is not buying. It is the final exhalation of the trend. The institutions are not purchasing on that day. They are selling into the frenzy. Every amateur who rushes in to chase the move is buying from a professional who is desperate to unload before the reversal begins. The enormous volume is the sound of distribution masquerading as enthusiasm. After a climax run, the stock almost always enters a period of struggle, stalling, churning, refusing to make new highs despite repeated attempts. Volume often drops sharply. The support that held during the trend begins to give way. And then the decline begins, slowly at first, then with increasing momentum as the latecomers finally surrender. I want you to think about how many times you have chased a stock into exactly this moment. How many times have you bought the excitement, only to watch the position immediately move against you? This is not bad luck. This is the climax run. And now that you know its signature, you will never mistake it for opportunity again. Speaking of recognizing patterns that destroy traders, if you have not yet watched our video called The Chart Pattern That Destroys Greedy Traders, I strongly urge you to do so immediately after finishing this one. That video covers the specific chart formations that have bankrupted more traders than almost any other factor, and understanding those patterns alongside what I am teaching you today will give you a formidable edge. Find it on our channel. The link is in the description. Now, let us talk about volume in the context of support and resistance, because this is where the relationship between these two forces becomes truly tactical. When a stock approaches a key level of support or resistance, the volume behavior at that level tells you whether the level will hold or break. A resistance level tested on low volume is weak. The market is not committed to breaking through. It will likely hold, at least temporarily, but a resistance level attacked on surging volume is a different matter entirely. The buyers are committed. The pressure is real. The level is in danger. Conversely, when a stock pulls back to support, watch the volume on the pullback carefully. If it declines on light volume, if the sellers are few and hesitant, then support is likely to hold, and the pullback is a buying opportunity. But if the stock falls through support on heavy volume, accompanied by wide-range down bars, then the move is real. Do not argue with it. The market has spoken with conviction, and conviction must be respected. The great mistake of the amateur is to treat levels as walls, as though a price number itself possesses magical stopping power. Price levels have no power of their own. Their power comes entirely from the volume activity around them. A support level held on massive buying volume is fortress-like. A support level held on nothing more than a lack of selling is paper-thin. Learn to tell the difference, and you will avoid the endless trap of buying breakdowns and selling breakouts. There is one more concept I want to plant in your mind before we move to the final section, and it is one of the most practically useful tools you will ever apply to a chart. It is called the volume price divergence, and it is among the earliest warnings the market gives you that a trend is approaching its end. A divergence occurs when price and volume begin to move in opposite directions relative to what they should be doing. In an uptrend, each new price high should be accompanied by increasing or at least sustained volume. When you see price making new highs while volume is progressively shrinking, that is a divergence. The trend is losing participation. It is still going up by momentum alone, like a freight train that has lost its engine but has not yet felt the weight of the hill. I have used this signal more times than I can count to exit positions at prices I would have otherwise clung to out of greed or hope. The divergence does not tell you exactly when the trend will end. Nothing tells you that with precision, but it tells you that the risk has shifted, that the balance of probabilities has turned against the continuation. And when the probabilities turn, the wise man adjusts his position. He does not wait for certainty, because certainty always arrives too late. Now I want to address a question that every serious student of volume eventually asks. On which time frame should I be reading volume? The answer is, always start with the higher time frame and then move down. The weekly volume chart tells you the strategic story. It shows you the months-long campaign of accumulation or distribution. The daily chart fills in the tactical picture, the individual battles within the war. The intraday charts show you execution points, but the higher the time frame, the more weight it carries. A volume surge on the weekly chart is far more significant than a volume surge on the 15-minute chart. The larger the time frame, the larger the participants behind the move. I have always traded with a higher time frame as my compass. I never entered a trade that was going against the current of the weekly chart, no matter how compelling it looked on the daily. The higher frame governs. This principle is non-negotiable in my method, and it is one of the reasons I survived markets that destroyed the majority of my contemporaries. If you want to understand this principle in full depth, we have an entire video dedicated to it. Why higher time frame always wins in technical analysis. That video explains exactly how to align your trades with the dominant trend using multiple time frames, and it pairs perfectly with everything I have taught you today about volume. Watch it. It is on our channel, and the link is in the description. Now let me give you a practical framework, a way to actually apply all of this the next time you sit down in front of your charts. First, identify the trend on the weekly chart. Is price making higher highs and higher lows, or lower highs and lower lows? Establish the primary direction. Then look at the weekly volume during the trend. Is it confirming, rising on up weeks, declining on down weeks? Or is it diverging, warning you that the trend is aging? Second, move to the daily chart. Find the most recent base or consolidation. What did the volume look like during that base? Was there evidence of accumulation, persistent volume slightly above average on quiet price days? Or was the base thin and unconvincing? Third, when the price approaches its breakout point, watch the volume on the breakout day itself. For a valid breakout, I want to see volume at least 50% above the 20-day average, and ideally double or more. The bigger the volume surge on the breakout, the more conviction behind the move, and the greater the probability that it will follow through. Fourth, monitor volume during the subsequent advance. Is each new push to higher prices accompanied by volume, or is the stock drifting higher on fading participation? The moment volume begins to consistently contract as price climbs, your exit preparation begins. You do not sell immediately, but you tighten your stop. You stop adding to the position. You begin transferring your risk to the market's reward. Fifth, and this is the discipline that separates the survivors from the casualties. When price falls through a key level on high volume, you exit. Without debate, without hoping for a recovery. The market has spoken, and you respect the verdict. I lost fortunes in my early years by arguing with the market. I recovered those fortunes and built far greater ones, only when I learned to listen instead of argue. This framework is not complex. It does not require advanced mathematics or exotic indicators. It requires only that you observe what the market is actually doing, rather than what you wish it were doing. Volume is the market's truth serum. It cannot lie indefinitely. And if you build the habit of consulting it before every trade, before every entry, before every exit, you will find yourself making fewer decisions, but far better ones. I want to close by telling you something that took me many years and many losses to fully understand, and it is perhaps the most important thing I can leave with you today. The market does not owe you anything. It does not care about your analysis, your opinions, your needs, or your desires. It is a vast, impersonal force governed by the collective greed and fear of every participant who has ever placed an order. And yet, and this is the miracle, it leaves traces. It leaves footprints. Every major move that has ever occurred in the history of markets was preceded by volume signals that, to the educated eye, told the story before it happened. You are watching this video because you are not willing to remain ignorant of those signals. You are here because you understand that the difference between a gambler and a speculator is information. Specifically, the information that most people never bother to find. And now you have it. Not in theory, not as an abstraction. You have it in the form of a practical, battle-tested framework that you can apply to any chart, in any market, at any time. The price tells you what the market is doing. The volume tells you whether to believe it. Together, they tell you something that the majority of participants will never see, and that invisibility is your edge. Before you leave this video, I want you to do 3 things. First, go to the description right now and get both of our books. Thinking like Jesse Livermore. Mastering the market with discipline, patience, and risk will give you the strategic philosophy you need to approach the markets the way the professionals do. The Livermore Journal, a 90-day trading psychology workbook, will take you through the daily psychological work that separates the consistent winners from those who know the theory but cannot execute it under pressure. Both links are in the description. Do not wait. Second, watch our other videos on this channel. If you want to understand the patterns that destroy greedy traders, patterns that volume confirms with deadly accuracy, Watch the chart pattern that destroys greedy traders. If you want to understand why the higher time frame always governs every trade, watch why higher time frame always wins in technical analysis. And if you want to master the complete process of trade selection, knowing not just when the setup is right, but when the timing is right, watch how to spot the right trade at the right time. Each of these videos deepens what you have learned today, and together they form a complete education in reading the market the way it deserves to be read. Third, and I say this with complete seriousness, leave a comment below this video. Tell me what you learned. Tell me which of the 4 volume price combinations most surprised you. Tell me if you have seen a climax run in your own trading history. The comment section is not decoration. It is where traders compare notes and sharpen one another. Use it. The market has always been here, and it will always be here. The question is whether you will be here to profit from it, not by chance, not by luck, but by understanding. Volume and price are the hidden relationship that predicts market direction. And now, that relationship is no longer hidden from you. I am Jesse Livermore. I lost everything twice. I built it back twice. And everything I lost because I forgot what I am telling you right now. Do not forget.